Mind talking a little bit about why the Texas markets? You're over there in California. Why did you focus in on Texas and specifically the Austin and San Antonio markets?
Yeah, so as I was growing and with these two guys, my mentor and my mate, I knew I wanted to. They were sort of the lead syndicators, right? And I wanted to do my own stuff. And because I'd been involved in a few deals in Dallas Fort Worth, co-syndicating, whatever you want to call it, I was quite familiar with the markets and the moderate cap rates. And so then, but I realized I needed to sort of go play my own fiddle and not play second fiddle to these guys. So I went off and started looking at deals by myself. And the reason I chose Texas, more the fact was that I happened to be involved in a couple of deals early on in the Central Texas markets, knowing that they had moderate cap rates back then, and still today, compared to coastal markets, right? So, and the big thing was cash flow. 6-7 years later, we can look back and some of these markets that I'm now invested in have got very compressed cap rates, and have transitioned somewhat into coastal markets themselves. So, but that's not necessarily a bad thing. So your question was why? It was more to do with the fact that if you have a moderate cap rate and your cap rate, and there's a delta between your interest rate and your cap rate. So for example, if you have a 5.5% cap rate and you have an interest rate of 4%, then that 150 basis points means you're going to be able to create cash flow. And that was the most important thing. Where, say, in a coastal market, you might get a 4% cap rate and a 4% interest rate. Well, there's no expansion, so there's no delta, so you can't have any cash flow. So that was really the impetus to go to start hunting in Texas, and ultimately now we have 2,000 units down there, in San Antonio and Austin, focusing more on Austin today than we were when we got started in San Antonio about 3 or 4 years ago. So yeah.
So you talked a little bit about the spread between cap rates and interest rates. What else do you look for in a deal? And then, if you can I don't know if you talked about two different people, so I don't know if one of those is Andrew Campbell or not, but if they're not, I guess how you found him, and then
sure,
kind of how you guys divvy up the responsibilities.
Yeah, so early days was now called Ashcroft Capital. Joe and Frank, I've already mentioned the names. So that was where I got my start in that Houston deal that I spoke about. Cool. Breaking out into doing my own stuff was hunting on my own, and then through an introduction to Andrew Campbell, we quickly realized that I had a very analytical background at that time in my career. I was working for a big real estate developer here in Los Angeles, building large multifamily. Again, my background's in structural engineering, so I came from that institutional world. I was underwriting deals. I was quite knowledgeable at underwriting deals, but what I was missing out on was those boots on the ground type of that lead edge, right? And I was underwriting deals in San Antonio and some smaller deals in Dallas Fort Worth. I was getting on best and final calls, but I just didn't have that broker relationship. Brokers saying, who the hell is this Australian guy calling from Los Angeles? And that's where Andrew was boots on the ground, and he wasn't as focused on the operations and the systems like I was focused on. And so we really had a yin and yang type of complementary skill sets. And that was the most important thing that he was hunting some deals by himself as well. We were pretty much coming across the same type of deals. We're comparing notes. We just said, hey, why don't we just partner up here? And you seem like a guy that can hustle as hard as I can. We have very much similar values. But it ultimately boiled down to having those complementary skill sets. And that's really important for everyone listening on this webinar. If you're looking for a partner, getting involved in large commercial multifamily, there's a lot of hats to wear. And having someone a partner that can take some of those hats or responsibilities off your plate is really, really important, because there's a lot to go around in terms of the pie. And so sharing that with someone else is okay in order to help you grow and scale. So that is where Wildhorn Capital started. And that's where our first deal was 192 units as Wildhorn Capital. And that's where we've now grown to 2,000 units at Wildhorn, about $250 million assets under management. So yeah.
Wow, that's awesome. So you've got 2,000 units in Austin, San Antonio. What's kind of the future plans from there? Are you still focusing on those markets? Are you looking outside of that?
Yeah, I think for us, it's not so much on San Antonio as much anymore, just because of It's a slow and steady market. It's a great market to get started. It's a lot more affordable than, say, the other metros in Texas. Like you think of Dallas, the boom it's has had, I should say, over the last couple of years. Same with Austin. We're really focused more in the Austin market today. And the reason is we're focused on that is through the investment thesis that we at Wildhorn really portray. And that's, and it's a little bit of my international perspective as well. It's that Austin has really been the poster child of a transitioning city from a secondary market into a primary market, I should say, over the last 20, 25 years. And that's through systematic investments by the local municipality into infrastructure and attracting business into a town that is, more artsy and has a scene going on. And that is attractive to investors. And that's really what's transitioned Austin to be on the world stage right now. There's a lot of tech companies going there. Tesla just announced the Gigafactory that's moving to Austin. Obviously, Apple and Google are there as well. But I look at other things like population growth, right? Like I come from a country in Australia where it's very similar to coastal markets here in the United States, where the demand is high but the supply is low. And when the demand is high and the supply is low, you have cap rates will compress. And that is really important because as you grow, you want that demand to keep being there consistently through jobs, right? So it's all about the jobs. Coupled with the continued investment in the municipality and infrastructure and the growth of the city. And that's really why we look at Austin, all the things that are going on there, it's attracting big companies. It's putting a lot of investment into its infrastructure in and around growing the city. And where I compare to someone like San Antonio, where it's a more of a old school type of money. Everyone's pretty happy with what they've got, and they're not as excited to spend money on itself in order to attract the international type of business, right? In Austin, there's direct flights to and from London a couple of times a week. It's really on the map when you think of world cities because of its tech scene. And that is for us a really important metric and something that we want to be involved in for the long term. And for us, we're not about making a quick buck here. We're about investing over the medium to long term, 7 to 10 years. And when you have that investment horizon and you're in a city where there's a lot of demand and low supply, your existing product, you may overpay compared to, say, other secondary, tertiary markets. But the fact is you're going to be insular to when there's a downturn and when those secondary, tertiary markets may stumble because people don't want to live there and there's an exodus of population. That is where markets like coastal markets, Austin markets, stuff like that, Denver, Colorado, when you think of the other growing markets, where people want to constantly live there and want that. The demand is there, but we've got to catch up with supply. Coupled with the fact that also new product coming to market in Austin has very similar barriers to entry as coastal markets. It takes 2 or 3 years, to get through planning approval in Austin. The price per dirt of land in downtown Austin is trading for as much or more as price of dirt in downtown Los Angeles. So, for high-rise, condominium towers. So when you're thinking of that type of stuff, your existing product is really valuable and will continue to be valuable when there is a barrier to entry for new product into a market. Again, supply and demand. So overall, that's our thesis, and we are going to remain sort of an inch wide and a mile deep in that market for the time being. There's over, I think, 40,000 units in Austin. We only have 2,000 in separated across San Antonio and Austin, and we don't necessarily want to be a company that wants to have 20 or 30,000 units. We're very sustainable in our growth. We want to, we think if we get to 4,000 to 5,000 units and we keep, we sell 4 deals a year, we buy 4 deals a year, that's pretty consistent for us. And we don't ever have aspirations to want to be 20,000 units. And we'll look at other stuff, right? We'll look at other things that we're currently looking at hotel conversions, converting existing extended stays into low-cost housing and getting tax credits for it. We're looking at highest and best use of specific land buys, meaning we might buy an 80-unit property in a very key location in Austin that may not be coming today, but in 5 or 10 years' time, we know that it's going to be valued more and we could go and increase the density on it. So different ways of looking at adding value to a property rather than the traditional, which we do, putting lipstick on a pig and trying to charge $150 more a month for. So yeah, that's really our thesis here in the next coming years.